Hello, everyone. This is AI Crypto Insights, your AI analyst speaking. Now, just a quick reminder, this video is for educational reference only, and it does not constitute any investment advice. Crypto investing carries high risk. Okay, with that said, today we're breaking down the wild market event that people are calling the $646 million crypto slam. We're going to get you the key insights in just minutes. So let's start with this number because it is staggering. $646 million. In just 24 hours, that's the total value of leverage trading positions that were just, poof, vaporized. This wasn't some slow drip. It was a sudden, violent flush of capital that completely blindsided thousands of traders. So what on earth was the trigger? Well, the catalyst was a sudden, sharp drop in the two biggest assets in the entire market. Bitcoin plunged over 5%, and Ether got hit even harder, falling more than 6%. Look, on a typical, quiet weekend, a move this big is way more than enough to spark a massive chain reaction. To really understand that chain reaction, we have to get into the core mechanic at play here. So let's break down a key term. What exactly is a liquidation when we talk about crypto trading?
In the simplest terms, a liquidation happens when you're trading with borrowed money, leverage. If the market moves sharply against your bet, you can quickly lose your entire initial deposit, which is called your margin. At that point, the exchange's system doesn't call you up to ask what to do. It just automatically force sells your assets to get its loan back. It's not a choice, it's just automated protocol.
And this is exactly where we get that domino effect. That initial price drop knocks over the first set of dominoes, the traders who were leveraged to the absolute max. Therefore, sales then push the price down even further, which, you guessed it, triggers the next wave of liquidations. It creates this vicious downward spiral, a cascade that can pick up speed with absolutely terrifying results. So that's the theory, but now let's actually look at the data from this event itself, because it paints a very, very clear picture of what happened. The data here shows an absolutely overwhelming imbalance. Look at this. Nearly 90% of all liquidations were long positions. These are traders who are betting on prices going up. This tells you that the market was just saturated with bullish optimism. So when the price suddenly turned against them, they became the primary casualties of this whole event. And the damage wasn't spread out evenly. It was really concentrated on the largest crypto derivatives exchanges. As you can see, Binance, Hyperliquid, and Bybit each processed over $160 million in liquidations. This is a huge indicator of where the vast majority of this leverage trading activity is actually taking place. And to really put the scale of these losses into perspective, just get this. The single largest liquidation was a massive $14.48 million bet on Ether that was force closed on Binance. A single trade, a fortune just wiped out in an instant. Okay, so we've analyzed the what and the how. But to get the full picture, we really need to zoom out and look at the broader market conditions that kind of set the stage for this cascade to happen in the first place. And here's some crucial historical context for you. The month leading up to this event was actually Bitcoin's worst November since the deep, dark bear market of 2018. A drop of nearly 17.5% had already put the entire market on edge, leaving a lot of traders in really vulnerable positions. So what we have here is what analysts are calling a perfect storm of factors. First, you've got thin weekend liquidity. That just means there are fewer buyers and sellers, so smaller trades can have a much bigger impact on the price. Second, as we saw, the market was just flooded with crowded bullish bets. And finally, you have this ongoing uncertainty in the global economy that's been making investors nervous for a while. You mix all that together and you've got a recipe for disaster. In events this violent, this deleveraging, it definitely flushed a huge amount of risk from the system. But it also leads to the crucial question that's got to be on every investor's mind right now: where does the market go from here? As you might imagine, market analysts are pretty divided on what this all means. Two main stories have emerged. Was this a symptom of a deep structural problem, or was it actually a healthy and necessary market cleanse? So, the first perspective from the Cabesi letter argues that this whole domino effect is really a symptom of a structurally weak market. In their view, this crash wasn't some random event, but a reflection of the inherent fragility that gets created when there's just too much leverage in the system.
But then you have the counter-argument from an analyst named Psychedelic, who frames this as a positive. From this viewpoint, the market successfully swiped all that excess leverage that was holding prices down. It was painful, no doubt, but ultimately a necessary reset that could clear the path for a much healthier move upwards.
So the key takeaway is this. Thin, weakened liquidity acted like a magnifying glass on a price drop, which then triggered a cascade of forced selling that just wiped out a ton of over-leveraged bullish traders. So what's your analysis? Drop your thoughts in the comments. See you in the next episode.